Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving insight into what's on our radar. Today's outlook is for the week of May 13th, 2019. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. But before we get started, don't forget to subscribe to this channel, the Paul Mampilly YouTube channel, so you'll never miss our weekly market updates. And as an investor, we would love to know your thoughts and questions on the topics we'll cover today. So be sure to comment below so we can follow up with you. So today I'll cover three major topics. The first of the major topics, I'll be looking at the recent ongoing U.S. tariff discussions, the upcoming economic releases for the week, and U.S. earnings on the earnings front in general. And the second will be my story of the week, and the third will be the latest performance numbers on the disruptification index. As the U.S. China trade discussions continue, I thought it would be helpful to show how the 10% imports on tariffs enacted back in 2018, how they affected the U.S. consumer. So Bloomberg created this telling chart that demonstrates how U.S. households were, quote, well insulated from the 2018 tariffs, end quote. In all, the 2018 tariffs were deliberately targeted at Chinese supplies versus the U.S. consumer. This chart ultimately depicts the impact of those initial round of tariffs on the U.S. consumer. As you can see by the black line in this chart, the core consumer price index stayed in a tight range, ending 2018 at 2.1%. This was in line with the range reading since 2012. And that overall consumer sentiment inflation expectations looking forward 5 to 10 years, as seen in the green line, remained flat at 2.5%. Now, the effect of the new round of U.S. tariffs on China imports imposed on Friday remains to be seen, as well as China's reciprocal tariffs on U.S. imports. But it's important to note that the negotiators have given themselves wiggle room for a few weeks. And the reason why these U.S. imposed tariffs on Chinese goods that went into effect on Friday would affect container ships leaving Chinese ports on or after midnight this past Friday. So these ships carrying tons of goods that are currently in transit before that time will not be taxed at the new 25% rate. And it takes container ships up to 3 weeks to make the overseas journey. So it's possible a deal could be struck during this transit time. Now, looking forward to this week's economic releases, it will be another fairly light week, with most of the econ releases taking place starting Wednesday. So here are the most significant releases for us to keep our eye on. So as you can see in this graphic, on Wednesday, retail sales advanced month over month for April will post at 8:30 a.m. Empire Manufacturing for May will post at 8:30 a.m. And industrial production month over month for April will post at 9:15 a.m. On Thursday, we'll see April's housing start numbers at 8:30 a.m. And on Friday, the May preliminary release for the University of Michigan sentiment and the April release for the leading index will both be released at 10 a.m. And as I mentioned last week, earnings season is definitely winding down. Check out this list of some of the top U.S. securities reporting earnings this week per Bloomberg. There will be a total of just 21 releases, and these companies include Cisco Systems, Walmart, and Deere and Company. Now, my story of the week focuses on a new entrepreneurial undertaking being proposed by Amazon. Amazon is now encouraging its current employees to quit their jobs and start delivering packages. You may recall in recent weeks that Amazon announced they're now moving to a one-day shipping for their Prime members. Now, this is a massive undertaking that will have implications across the retail sector. So, to meet this challenge, Amazon officially announced today that If one of their employees quits their current job, Amazon will pay them $10,000 in startup costs. Now, with the deal, the company will also pay 3 months' worth of salaries. Now, this offer is available to full-time and part-time Amazon employees, as well as warehouse workers. Now, as you can see in this graphic, Amazon projects these new entrepreneurs to earn potential annual revenue from $1 million to $4.5 million, with a potential annual profit of $75,000 to $300,000. Now, the fundamentals for this program actually began a year ago, and there have been success stories. Now, AP is reporting the pilot program, which was then open to the general public, has already produced 200 Amazon delivery businesses. One business startup based in Atlanta, which was founded just 8 months ago, already has 120 employees and 50 vans delivering up to 200 locations per day. In all, Amazon's big picture goal is delivering more of their products without depending on outside carriers like UPS or the post office. So if you have an entrepreneurial spirit, this may be a startup idea for you. So lastly, turning to our disruptification index, this chart shows it continues to outperform major indices year to date. And as of Friday, May 10th's close, the index is up 21.9% versus 11% on the Dow and 14.9% on the S&P 500. So that's it for me. Ian, what are you watching for today?
Thanks, Amber. So this week I want to talk a little bit about the macro numbers, some economic releases that came out last week. So for example, on Tuesday, we saw that there was a reported 7.5 million job openings as of March. So that is a huge number. It's a record high, and it's about 2.85 million more job openings that we had before the financial crisis, back when the economy was growing pretty fast in 2007. So it's significantly higher than that. And within that report, there were a bunch of really encouraging data. So for one, in the transportation and warehousing industry, there were 87,000 more job openings in March. And then for construction, there was 73,000 more job openings, and real estate had 57,000 more job openings. So these are industries where you really want to see that job growth, because these are the industries that really drive the economy. You have things like construction and real estate, huge parts of the economy, where instead of shrinking, like a lot of people had predicted, you see growth in both hiring as well as job openings. So those are some really encouraging data for job openings. And then with jobless claims, which came out Monday, the number was 228,000, which is a little bit higher than what we've been seeing recently, although it's still the lowest that we've seen since 1974. So that's a 45-year low in terms of job openings, in terms of jobless claims. And now, compared to 2007 again, there are 2 million more job openings than unemployed people. And in 2007, there were 2.5 million more unemployed people than job openings. So even though a lot of people are comparing right now to 2007, it's a lot different. It's a lot more encouraging to see that many job openings compared to a smaller number of unemployed people. And that's exactly where we want to be. And month after month, it continues to get better. So we believe that there is no recession on the horizon. You really can't measure that yet, because we're just seeing continued improvements in all sorts of economic data, especially the job market, which of course is a fundamental part of the economy. And without the bad impacts in the job market, you can't really have a recession. So that's what I have for economic data. And I also want to talk a little bit about gaming in terms of disruption, because the overall media sector on a global scale is being disrupted by gaming. So last year, gaming became the #1 revenue generating form of media in the world, passing TV for the first time ever. So in 2018, there was about $116 billion generated in the global gaming industry. And it grew about 10.7% year over year compared to TV, which was the former leader, and it fell. TV revenue actually fell 8% in 2018. So that's it's impacted obviously by things like TV streaming or Netflix, Amazon Video, all those types of things are really hurting the TV industry. And in return, we're seeing gaming really start to thrive. And by 2025, the gaming industry is actually expected to generate about $300 billion in sales per year. So from now till then, that's only 6 years, and it's expected to almost triple in that time span. So this is an area that's going to see really high growth, being driven by things like mobile gaming as well as AR and VR, which are augmented and virtual reality. Usually those two are combined into one industry. So when I talk about VR or AR separately, the numbers have to do with that whole industry in general, which includes both. But I want to just give a couple of facts about mobile. So within the United States, about 164 million people play video games. Over 60% of that population plays games on their phone. So they're all part of the mobile gaming community. And one of the top, most revolutionary mobile games we've ever seen is Pokemon Go. And even though you really haven't probably heard much about that recently, since it really caught fire in 2016, 2017, it's kind of faded out of the public view. But over the course of that game's lifetime, it's generated about 1 billion downloads and actually is still generating a lot of revenue, even though it's free. So last month, Pokemon Go brought in about $65 million. And so far in 2019, it's made about $270 million. So even though the game is free, users can buy all kinds of stuff in the game, which is called freemium. And that's another big trend driving gaming, is especially in mobile, having a free game or a free gaming app. You can charge for things in the game, and people pay a lot because it's only a couple dollars at a time. So that's something that's really driving sales in the mobile gaming industry. And we've seen that for Pokemon Go, for things like Candy Crush, which has generated about 3 billion downloads since 2013 when that came out. So these are just a couple examples of how mobile gaming is really starting to grow. And in terms of VR, we're seeing huge growth in that industry as well, especially through headset sales. And the AR VR industry actually generated about $12 billion last year, which is triple what it did in 2015. So that is exponential growth that we're seeing in VR and AR. This year, it's supposed to grow from 12 billion to 20 billion, which is pretty amazing that it continues to do this, because for years, there was a lot of hype and a lot of expectations surrounding this industry that really didn't pan out. But now we're starting to see that growth really materialize, and these technologies are really starting to be used on a mass adoption scale. So I just want to give a few numbers for VR sales that we saw last holiday season, because these really blew away any sort of record that we've seen before. And in the last quarter of last year, some of the big ones like PSVR, which is the VR headset that you can use with a PS4 or a PS3, there were 700,000 sales of that headset just in that quarter alone. And then Oculus Go had 555,000 sales. And another one called the HTC Vive had 130,000 sales, although that one was actually the revenue leader because it's a lot more expensive, but people still buy it clearly, over 100,000 sales in one quarter. So if you add all that up, that's almost 1.5 million headsets sold in just one quarter. So we're really seeing this start to take off. We believe that gaming is really going to start to grow even more, especially with these revolutionary new industries of mobile, VR, and AR. So make sure you keep an eye out for the article that I'm going to be putting out on Thursday, because it's going to go a lot more into detail into these industries. And I'm going to also give an opportunity to invest in these industries as well. So make sure you keep an eye out for that. And that's all I have for this week. So Paul?
Thanks, Ian, and nice plug there for your article to come out this week. So obviously, if you're checking on markets today, you'll see that there is a lot of scare in the market. I just got a text alert on my phone saying that the market is down 1.7% at the open. And it just made me think, well, wasn't it just like a week ago, guys, that we were at all-time highs, right? I mean, it does show you how fickle the mindset of investors are, which is we can go from being like, hey, I'm okay with, all-time highs, and whoa, I'm all out. And when you see these big drops essentially overnight, it tells you that some number of investors are just clearing their stocks out of their portfolio, and they're willing to take substantially low prices for it. And obviously the bet that they're making is that these trade wars are going to be long-term events, that they are going to depress the values of stocks, and by doing so, reduce the demand for stocks. And in other words, stock price will go down. However, just to go back, just remember, we just had a 10-year high number print for productivity, which is really like something that economists have been so negative about for really something like 20, 30, maybe even 40 years. So, I mean, it's a big deal, especially when you consider that we've got all this stuff going on with technology that, we talk about: Internet of Things, blockchain, robotics, artificial intelligence. And this is, for me, a manifestation of this. We also had a GDP number print of 3.2%, which is, was happened within, an environment where we had tariffs, lower tariffs, and what is being proposed today. So 10%, now we're going to jump to 25%. And we've also seen, people sort of learn to adapt to this environment where it is getting harder and harder to do business with China. Unemployment, as Ian has focused on often, is low. There was an article in the Wall Street Journal this weekend about how small businesses are struggling to be able to add people, which is that it takes, in some cases, 6 months to be able to find anybody to fill positions. And housing, even though we haven't touched on it, Zillow, which is in one of our services, had a very good quarter. And they're on the sort of, the tip of the spear of disruptification of the real estate industry. However, there's something else going on there too, which is that housing, like many other parts of our economy, is obviously being disrupted, as we tell you about. It's also transitioning to the other big mega trend theme, which is demographic, that we talk about, which is the shift of focus to the millennial generation. It's moving from the boomer luxury set to the millennial starter and sort of step up housing sort of model. In other words, people who are buying their first home, or people who are stepping up to their first sort of bigger home from there. So I would tell you that all bull markets, what they say, they ride a sort of wall of worry. If you think back, there was, issues around the euro, around the, where U.S. debt was downgraded. There was the debt ceiling in 2010, 2011. I mean, there's just been so many things. I try to make a list. I mean, it was almost impossible, really, because nobody can really remember. If you remember, Greece was a big deal for a while. There, Brexit. I mean, there have just been thing after thing after thing. And so just to prepare for this, I went and looked. On a monthly basis, the United States exports about $26 billion worth to China. And in the context of our economy, it's still fairly small. In the context of any single company, it can be fairly large. So, and then on the flip side, China actually exports about $126 billion. So it's a lot bigger deal for them than it is for us. Now, there's no question about it. It's a negative for us on the margin, and it could reduce GDP by, a quarter to a half, maybe worst case scenario be 1%. However, we have a lot more room to give on that front. And then you should also remember that on the flip side, in terms of the markets always anticipate. And so they never wait for the event. So when you see markets moving down, they're anticipating that some amount of the worst case scenario might happen. And so they price that in. And however, we can also have things like the Federal Reserve could cut rates. And if they did, that would be a big boost to valuations, because interest rates are the critical factor in valuing stocks. And so you just always remember that there is always a rolling mechanism of how people think about markets, anticipate markets, trade markets, that shift things around. Now, we've been talking a lot about IPOs on Mondays. And Uber came public, and it came at 45, and in truth, it kind of fizzled. It came at 45. That was where the IPO was. The first opening trade was at 42. I just checked this morning, and it was set to be down another 7% or so. So Amber, Ian, and I, and my publisher, we've been looking at Uber, And we actually like the IPO. However, we anticipated what was going to happen because we've been keeping track of everything that's going on. And Amber and I, we've worked out using something like 5-6 years worth of IPOs that there are some critical factors to getting an IPO right. And we're going to use everything that we have learned. And I believe this stuff is really, really very, very good stuff where we could generate enormous performance. We're going to put all this knowledge and expertise into our IPO service that my publisher and I, we are looking to start somewhere in the next couple of months or so. So just watch out for that. Now, I'm going to skip the popular company stuff because really, today I know most people be focused on the trade wars. And I would tell you that, I wrote an article back in June of last year focusing on companies that would be affected by the trade war. And in it was named Boeing, Apple, Starbucks, General Motors, Walmart. And most of them have two-way exposure. They both manufacture in China, and at the same time, they also are looking to sort of get Chinese customers themselves. And so they have two-way exposure because they're manufacturing some number of parts there, which would now be tariffed and increase in price as they brought them into the United States. I think some number of people have waivers for it. So it's never quite a straight calculation. However, the big global companies are the ones that have the greatest exposure. A small company, it's very difficult, to manufacture in 1 or 2 locations in the United States, let alone have a gigantic, footprint of manufacturing outlets. So generally speaking, it's going to be the big global companies that just really sort of benefited from the last boom that are going to be most affected. And a large part of being focused on disruptifying companies is that they're fairly new. And for the most part, they actually have a lot less global exposure. So I would expect our stocks to go down less. However, our stocks are volatile, so any given day, that bet might be off. Also, you also know that I've been telling you that I'm very, very optimistic on cryptos. And this weekend, I was blown away to see that Bitcoin just suddenly surged like 15-20%. And it went from sort of the high 5,000s. I think last time I did this was 5,800, and it hit $7,500. And if you remember, I made a video calling the bottom when it was about $3,800. So it's nearly doubled since then. And really, the argument for Bitcoin in particular really comes to this for me. In previous times, during a period of uncertainty, especially around trade, global issues, and concerns about inflation, people would go to buy precious metals, gold, maybe silver, maybe platinum, and things like that. However, today, people want Bitcoin. And that's really clear because when you see the trading that's going on, it's really coming from lots of globals because you know what? Financial markets are closed in the United States on the weekend. So this movement is being driven by global markets, people who are buying Bitcoin from around the world. So just want to give you guys an update. And where Bitcoin goes, ultimately it will take some number of the Bitcoin and some number of the other cryptos, and other cryptos I think will actually fall. This will be the beginning of the sorting out process that really sort of separates the wheat from the chaff. So that's all I have for this week. Back to you, Amber.
Great. Thank you, Paul and Ian. Spot on insights as always. And thanks to our viewers and our readers for tuning in to this channel, the Paul Mampilly YouTube channel. So please be sure to subscribe to our weekly updates to stay up to date on current stocks and companies that Paul and the team are looking into by clicking the subscribe button below. So until next time, have a wonderful week, everyone. Take care.